You've probably seen the headlines about Archegos by now, but will things settle down after this? Or can we expect a domino effect causing more and more collapses throughout the market going forward? Last week, we saw Archegos Capital blow itself up, basically from over-leveraging. The guy running the fund, named Bill Huang, was apparently leveraging borrowed funds up multiples. And we all know what happens when we're over-leveraged and things go against us now, right? Yeah, if you're leveraging 10x and you can amplify your gains 10x, but if you don't have the resources on hand, which Huang at Archegos did not, and the trade goes against you, the banks representing your trading are going to be stuck holding the bag. And they margin called the Archegos resources. One of the stocks he was in was Discovery, which was doing pretty well until it wasn't. Check out the stock price chart here. Just a few weeks ago, things looked like they were going really well, and then all of a sudden it collapsed, pulling the entire fund out from under him. So in this case, numerous banks like Credit Suisse, Nomura Holdings, and many more were on the hook to cover those losses. So Archegos gets vanquished, and the others need to clean up the mess, costing them millions, or in Credit Suisse's case, in the ballpark of maybe up to like $2 billion. But in the last few days, we've started to see more positivity back in the market, especially after Biden released his plan, showing a lot of potential indirect stimulus for the world. These larger funds probably don't like losing $2 billion for no good reason, but it's not really going to flatten them either. So will everything end with those banks just taking a hit and being able to move off towards a slightly less profitable sunset? Is the market now on the way to recovery, like it looks like it was today when I woke up here in Japan? Basically everything was green. So chances are, if you're interested in this video, you've also been following the whole Citadel and GameStop situation that continues till this day. If you don't know much about that, or you want a 1-minute synopsis of it, check out my rap shorts linked up here. That was basically my rap debut, and I haven't actually done much rapping since then. So let me know what your thoughts are in those videos. So Citadel could potentially be the next Archegos, except Archegos was a small baby of a family fund swimming off in some quiet, beautiful reef off in the corner of the ocean, whereas Citadel is like a whale in the global financial markets. User ATobbit1, or A2BITT1, on Reddit has put in weeks of research and due diligence into his masterfully created post on Reddit. I'm tempted to just read the entire thing off for you guys, but I'll link it down below so you can check it out. This post warns of a potentially massive depression-level onslaught that Citadel could single-handedly bring upon the world. It's kind of scary stuff, and reading it, I was kind of getting overwhelmed, not only because it's really technical, but also because if all of this stuff is true, and it does cause, the world markets to get wrecked, it's kind of like, what should I even do right now? So it's kind of like red pill, blue pill in the Matrix. Like, if you want to keep watching this video, please stick around. If it's going to make you uncomfortable and not sleep at night, the choice is yours. You can move on and pretend you never heard it. His post goes into the depths of government applications and expansive financial report forms, and his conclusion is that the mother of all margin calls could be on the horizon. Let me just read the intro header and the TLDR for you guys here. TLDR means too long didn't read, lol, which is like a thing people do on Reddit when it's just too much reading. So he says, TLDR, Citadel and friends have shorted the treasury bond market to oblivion using the repo market. Citadel owns a company called Palafox Trading and uses them to exclusively short and trade treasury securities. Palafox manages one fund for Citadel, the Citadel Global Fixed Income Master Fund Limited. Total assets over $123 billion, and 80% are owned by offshore investors in the Cayman Islands. Their reverse repo agreements are entirely rehypothecated, and they cannot pay off their own repo agreements until someone pays them first. The entire global financial economy is modeled after a fractional reserve system that is beginning to experience the mother of all margin calls. This is why the DTC and FICC are requiring an increase in SLR deposits. The madness has officially come full circle. And before I go into that article, I should also mention that it's come to light that Ben Bernanke, the chairman of the Federal Reserve from 2006 to 2014, is Citadel's senior advisor. So keep that in mind as we look a bit more at ATobbit's research here. I'm going to simplify the thread massively, so if you have questions about anything, please check it out, link below, or even just go over to Reddit and join the conversation. He has links to all kinds of resources citing his due diligence as well. So to understand what's going on, first we need to understand that hedge funds and commercial banks are constantly moving money back and forth so that they can have liquidity. Banks are in the habit of buying stocks or giving out cash to help you buy a house. Like loans, So when they need to borrow more money for a few days, even just if they see a good deal, they set up a repurchase agreement, like a quick loan, usually for a few days to get a big chunk of cash and then repay it in a few days plus interest. These are called repos. What enabled breaking the world economy back in 2008's crash was the collateral for a lot of these repos was super low quality bundles of risky mortgages or mortgage-backed securities. When the world realized that this collateral wasn't really worth the money that it was being traded for, we saw the price of repos skyrocket as supply and demand dictates. This chart shows the repo rate with 2007 on the left, and we see recent news on the right causing it to spike up temporarily. So what happened in 2008 was that rather than the Lehman Brothers classifying those mortgage-backed securities they lent out as collateral as payables in their accounting, they reported them as sales. So they're just like, wow, we're making so many sales. This is so easy, but it's just collateral. So they're basically tricking everybody that way. Eventually, things started to fall apart because our entire financial system is based on margin, and the Fed had to step in and buy all the garbage mortgage-backed securities with a $190 billion bailout package to keep things afloat. So going back to the chart I just showed you, we see that again overnight for a brief period a couple of times in 2019. To keep the wheels greased, the Fed had to step in with some good old quantitative easing so liquidity could be maintained in the markets to avoid more system-breaking failures. So in more recent news, you've probably heard about the 10-year Treasury rate going up, causing the markets to panic a bit and sell off in recent weeks. That was one bit of news, but since the crash in 2008 was caused by people shifting around crappy mortgage-backed securities for repos, those aren't as common anymore. This time, US Treasuries are the main ingredient for repos, making up about 67% of all repos. Check it out here on this chart. It shows on the right side, you can still see MBS mortgage-backed securities make up about 19% of collateral. But on the right, UST, that's US Treasuries, 67% of all collateral for repos are US Treasuries. So when you're using the Treasuries you have as collateral and all of a sudden the price shoots up on them, that's going to cause a margin call or at least boosted expenses depending on how big your repos are. Enter Palafox Trading, a market maker for repurchase agreement, which means they're meant to provide liquidity and progress to the market so things keep working smoothly, so things don't fall apart. Turns out Palafox, rather than being just a straight up trading company, is actually owned and operated by Citadel. Ben Bernanke's Citadel. As disclosed in their financial statements, you can see, like they say, yeah, we're owned by Citadel, as I show you here. So what this could mean is that Citadel has its own private repo market. So rather than spinning around their assets with other banks for repo deals, they just pass them off to their own market maker, Palafox. On the Reddit post, he put together this massive chart showing how everything is connected from publicly accessible documents. And it shows that everything is a part of the Citadel Global Fixed Income Master Fund, or as he indicates here, GFIL. Down there on the bottom. This controls $123 billion in assets under management. In another portion of the documentation, he mentions that about 80% of the fund's ownership is by non-United States persons as well. So it looks like this behemoth hedge fund that is capable of providing heavy influence over our markets is 80% controlled by non-Americans. Anyways, going back to the chart above with the overnight repo rate spiking, we see here on the right side, it goes boing all the way up. So in 2008, we had the same problem that everyone realized that these garbage mortgage-backed assets weren't actually worth anything all at the same time, as you can see Michael Burry doing in The Great Short movie. But now we're having the opposite problem. Basically, the Fed has printed so much money and there are so many treasuries flying around through the repo market that they've almost become interchangeable. Supply and demand would dictate that as assets in demand would yield a higher rate of return, but we see now that since about March 2020, the short-term repo rate is almost 0%. So we saw in the news a few weeks ago that the 10-year treasury's price has started to settle down a bit. But why would the yield percentage on the assets possibly go up when its yield is so low? The hedge funds are so confident that the 10-year treasury will continue to decline that they've started to short the 10-year bond market into oblivion. But similar to what we're seeing with GameStop drama, you can't short more of a stock unless you can actually get your hands on that stock from someone. So in the GameStop story, basically they've shorted more than the entire float of the number of stocks that are available for GameStop. It's probably still over 100%, but you can't cover your short if that number of stocks doesn't exist. And we're seeing a parallel thing happening on a much grander scale. In the same way, Citadel and all of its children funds are trying to short the treasury, but they need to get their hands on it first. So who do they call to do that? They're good friends at BlackRock. And actually, it's not really clear that they're buddy-buddy, as this puts BlackRock in like a super controlling position potentially, but it's pretty safe to say that they're on good terms. This is the same BlackRock that the Federal Reserve hit up to purchase bonds for the government not too long ago. So Citadel now has a source of shorting, and they throw it into Palafox trading and collect their cash. This works okay until they've shorted more than the entire capacity of treasuries available. Once again, similar to the GameStop story, and similar to what retail investors in GameStop are hoping for, there could be a short squeeze on the horizon. And when the short squeeze is larger than 100% of the available stocks, will we see an infinite loop of price explosion? In the post, he provides evidence that this is happening with Citadel as follows. There have been 3 instances over the past year where the repo rate inverted into the negative. So instead of paying someone to borrow from them, you're paying someone to have them borrow from you. So imagine going to the bank and they're like, hey, take all of our money plus interest. You get to just keep a bunch of extra money. And we're going to keep paying you monthly as long as you hold this loan. It's kind of like that. So in this case, they were needing to pay someone as much as 4.25% interest to lend their own money in exchange for a 10-year treasury bond. That's how backwards things are getting right now. So there's major desperation to find bonds going on, and this has already happened a few times. If big players like BlackRock aren't in the habit of purchasing more and more treasuries continually, eventually there won't be any places left for companies like Citadel to buy from, just like how things might happen with GME. Here's Palafox's statement of financial condition showing that they have liabilities of more than $31 billion in gross repo agreements, most of which were related to repurchasing treasury bonds. Do they have enough assets to buy those back like they're supposed to? Looks okay until you read the fine print, which says, typically, the company, or Palafox, has rights of rehypothecation with respect to the securities collateral received under reverse repurchase agreements. As of December 31st, 2020, substantially all securities collateral received under reverse repurchase agreements has been delivered or repledged in connection with repurchase agreements. Rehypothecation is, simply put, when you use collateral received from your clients for your own purposes. So let's say I lend you $1 million. I'm a bank. I lend you $1 million so you can make a house, and you give me collateral to lower my risk in the form of all of your Bitcoins. Rather than just holding those Bitcoins for safety, I turn around and lend those out on BlockFi, where I get up to 8.6% API and up to $250 crypto bonus for signing up with a deposit. Hit the link down below. No, but seriously, rather than just putting this collateral into a safe place to cover my butt, I use it to either buy other leveraged assets or as collateral in other transactions. So what ends up happening is, let's say you can't pay me back that $1 million. Your house, like something happens, you can't complete your house, so I don't have a house that I can sell, and you can't pay me back, and I don't have the Bitcoin that you lent me as collateral because it's already gone trying to make money somewhere else. And then separately, all those other places are doing the same thing, and they all get Archegos, and we all get Archegos. It ends up causing a chain reaction of destruction, basically. This means that securities which Palafox is waiting to receive have already been pledged to pay off the bonds they currently owe to someone else. But if you never get these securities, then the whole chain of supposed recipients ends up collapsing and everyone gets wrecked in the process. Here's a look at how Palafox's financial statements have been getting worse over the last few years too. First one we have is 2018. Securities purchased under agreement to resell, $5.1 billion. Securities sold under agreements to repurchase, $5.14 billion. Then you see that number go up by another 25% in 2019. And then you see it more than double in 2020, up to 16 something billion. Next, Enter the FICC, the Fixed Income Clearing Corporation, which is a part of the DTCC, or Depository Trust and Clearing Corporation. They function as a central securities depository to make sure securities transactions are completed promptly and properly. Turns out they have $47 billion just in deposits for unsettled treasury bonds. So there are massive amounts of treasury bonds that need to be sent back to them, but can't because they've been shorted so far, like so many times, that they might not even exist anymore. So if things went according to plan and the price of securities were going down, the short would pay off. Whoever's shorting those treasuries would, make out pretty well. But once again, like GameStop, if no one is selling, all these Redditors, all these retail investors are just holding on to their stocks. Nobody is letting them go. So whoever's shorting GameStop can never cover their losses. So they just have infinity losses racking up. In the same way, if you can never get your hands on any treasuries, what do you do? So again, I'm not saying GameStop is the cause of all of this. I'm saying GameStop is analogous to what's going on, but on a much bigger scale, because there's shady stuff going on behind the scenes that the government isn't regulating, and probably most people can't even really grasp in their minds anyways. Fortunately, we did see the SLR, or statutory liquidity ratio, get bumped up effective April 1st, which is today here in Japan, but depending on when I get this video out and when you watch it, it could have already passed. The DTCC and the FICC saw what was going on. They saw how insane the whole rehypothecation thing is and how potentially destructive it is for our markets. So they're putting the brakes on things and telling funds that they need to keep more on hand, more in reserve. They can't be doing leveraging and leveraging and leveraging without keeping anything on hand. Typically, I think the DTCC and the FICC update their standards every 6 to 12 months, which they did back in January a couple of months ago. But in this case, they're pulling an emergency update since the last one. And I think that's probably because they see that things could get really, really crazy coming up here. Keep in mind what I said at the beginning about Ben Bernanke being an advisor for Citadel through all of this too. He knows how all of this works because he used to run the Fed for a long time. It's pretty crazy to think about, isn't it? User Conscious Positive 54 wrote in another post that Morgan Stanley and Goldman Sachs' margin calls on Archegos is a heads up on what's coming in the markets. They realize that they need to trim their losses, they need to buckle up, because things could potentially get really bad. While it has seemed, for the most part, like the money printing by the Fed has been helping things from collapsing during the whole pandemic, we may find out that not only are there other side effects because of the potential for inflation, despite their firmness on the contrary, but we may be seeing that this printing has been enabling foreign-owned hedge funds to take the entire US financial system hostage via Citadel and advisors like Bernanke. This is where things get even more tinfoil. We say tinfoil hat because it's like, oh, conspiracy theory, prepare for the aliens taking over our brains or something like that. This is where things get even more tinfoil hat. But who do you think could be some of the foreign ownership of all of this? I shudder to consider the fact that it could be China, who's starting to be pretty pushy over here. In Japan, they're amping up the rhetoric and they're saying, you guys better not get involved with Taiwan, ... We saw them starting to invade the Philippines waters like over the weekend. If they were to strangle the entire economy mid-pandemic recovery while getting even more belligerent in their attacks on the likes of Taiwan and Japan, we could see something cataclysmic, not only for American wallets and American investors, but for the world as a whole. That's pretty terrifying stuff to consider. So what do you guys think? Feel free to join the chat below. I'm also working on setting up memberships and maybe some kind of Patreon chat thing coming up too. Let me know down in the comment section if you'd be interested in that, because I'm really enjoying the comments and I'm really enjoying getting to know you guys more, even over on Instagram, having a few conversations with people as well. But let me know what you guys' thoughts are about that. Looking forward to chatting soon. I love you guys and talk to you soon.